I would like to thank each and every one of you for taking out time from your busy schedule and making it for this amazing panel discussion based on the future of alternative real estate assets. I would also like to thank all the panelists for making today's event possible. Let me start by introducing our panelists. We have Mr. Karan Sodi, Managing Director, Mumbai and Ahmedabad, JLL India. We have Mr. Vinod Rohira, CEO, Mindspace Business Park REITs. We have Mr. Shiv Parekh, founder and CEO, hBits, the Fractional Ownership platform. We have Mr. Rachit Mohan, JLL India Head, Data Center Advisory and Co-Head Office Brokerage. And lastly, we have Mr. Adishesh Mitra, JLL Co-Head, Capital Markets, Mumbai and Pune. I would like to leave this over to you guys, and we look forward to an interesting discussion on all the current trends going on in the market. Thank you.
Thank you. You still need me to take the mic? Where's Monica? All audible, right?
So Karan is needed for the camera.
For the camera.
So if you're using that, it should be okay. Cool.
Yeah, I think the mic is
here. So firstly, welcome everybody to JLL office in BKC. I would love to also do a site tour later. But if you're making any visit to Gurgaon in the near future, do let us know. We've just built the state-of-the-art office. It's worth visiting. The latest technology. So just boosting about JLL a little bit. So while we have a great panel over here, and the theme is around alternate investments and opportunities for the next decade, what I want to just put in perspective on commercial to start with. So while 2019 we had a record year, especially in India, across top 7 cities in terms of absorption. We saw roughly 47 million square feet of absorption, first time ever in the history of real estate commercial in India. And first time ever again in 2019, 3 cities crossed double-digit net absorption mark. Bangalore typically used to do double-digit net absorption. So Bangalore was about 12 million, followed by surprising number 1 was Hyderabad, about 11.5. And interestingly, Gurgaon, NCR region was about 10.1 million. So great, hurrah, 2019, great year of absorption. People were gearing up for much successful year of 2020, and obviously we hit the road with COVID. And we saw a drop of roughly 48% in 2020 in terms of net absorption, and it was obvious. It's still, I believe it was still a good show, considering the way we entered COVID with no clarity, so many lockdowns. And then fast forward to 2021, we thought first lockdown, we didn't see much impact, especially on the live side, which was good at that point in time. We thought people should come back faster, but again, unfortunately, 2021, with the second lockdown being very fatal for the country, things were slow, and that reflected on the net absorption in office markets, was flat, similar to 2020 numbers, around 26 million square feet net. But the silver lining now to start with, Q1 2022 data is in. The top 7 cities in India, we've seen 48% of entire 2021 absorption in the first quarter. Roughly, we're looking at about 11.5 million square feet of net absorption only in Q1 2022 in the top 7 cities, versus 26 million of last entire 2021. So with that silver lining, I'll start with the legend of commercial real estate, Mr. Vinod Rohira. 27 years of stellar office-focused leasing, multi-city penetration, successful sales. I would call him the salesman of India on a lighter note. And now also one of the successful REIT managers also. So, you've seen this whole journey and trajectory. What in your view actually is causing this momentum to come back? And would like to understand from people's perspective, is it a short-term blip or what's the long-term story going to play out?
I mean, I'm sure you guys may have read all the JLL reports and the analyst reports, etc., for the last 3, 4, 5 years. Primarily, we need to understand what is the kind of commercial real estate getting built in India. We have only one true CBD, which is Mumbai. You have a little bit of Delhi, and Bangalore has a few spots for CBD, correct me if I'm wrong. Rest of it is really commercial real estate being built for tech companies to occupy. So if you rewind 20, 25 years back, you had the Infosys, the Wipros of the world and the TCSs of the world that were doing pure back office, low-end service work done bits and pieces for global customers. Now when you fast forward 25 years, India is at the pinnacle of actual patented tech that's getting developed from India. You have a workforce that no other country can match at 20% cumulative cost to what you get the same resource in America. 45% of the footprint today is GCCs and GICs. When I say GCCs, GICs, it's the company setting up their own offices in India as their back office. So with that kind of a footprint, today 700 odd million square feet of commercial real estate has got built in all shapes and forms. Out of that, 380 odd to 400 odd million square feet has been institutionalized. 90% of that is only tech footprint. In the last 2 years, when we saw the pandemic, of course, the first 6 months, 9 months went in making sure the rent is going to come or not, as traditional landowners, developers, etc. When we saw that that was behind us, we realized that 60% of the energy in the empty office was still getting consumed because their servers were there, their racks were there, the business gateway was the office. So it established the principle that you don't need to tangibly be on a desk to be able to occupy the office space. Even if it's empty, you're occupying the office space. So the customer knew that, we knew that, not a single rent went down. If your business shut down, obviously rent is not relevant. So that was the first step. Having said that, in the last 12 months, 3 things have happened. One is there has been a massive attrition that has taken place in across the board tech footprint for India. Almost 35 to 40% churn of people in 9 months. And there has been a 35% growth of human capital. So which means 60% more workforce has churned and come into light for technology services. So actually India has leapfrogged in the tech space because every company in America and Europe who wanted support services could not rely on that in America anymore, and all of those jobs actually came to India. Now, when we are seeing after the third wave, domestic India, 90% is back on the desk. Tech space was about 15% back on the desk on an India level, which is now still 20-25% back on the desk. So it will be a 12-month, 18-month journey for them to come back. 3 things are happening. One is, on an average, they were occupying 80 square foot a person. Now they will come back to occupy 120 square foot a person. So even if they are 60% on board and rest is so-called hybrid for the next 12-18 months, they will still need the same space, which is the reason why you're seeing the demand for real estate is back, because they are signing contracts left, right and center to fill up for the next 12-18 months of requirement for growth. So they are signing a lot of space, and the front runners are Bangalore and Hyderabad, followed by Pune. These are the 3 cities. NCR is just about started now to pick up. What's happened to Bombay is CBD has broken into 2 parts. Services are moving towards the extended suburbs, and the prime office is moving to the CBD footprint. So you're willing to forego grade B asset, pay higher rent and move the primary office to grade A, and the services is moving to a suburban location. So that's happened and accelerated in the last 6 months, and you will see a lot of that happen for domestic India, and especially in cities like Bombay, where you will see that growth. So cumulatively, in my view, 22 calendar year and 23 calendar year, you will go back to 46 million square. But sadly, there is no supply for the tech footprint. There's a lot of supply which the tech footprint may not occupy. So your vacancies will still be 18%. Grade A vacancy will be close to 0 in 18 months. So both of these things are happening, and we can debate more on it in terms of what assets will get chosen and leased and whatever else.
Thanks. And I'm just preempting from what you said and taking a cue from the audience. I'm sure this room will be actually builders of real estate at least the next 30-35 years coming front. So 2 things which I'll pick up. One was 700 million square feet of office real estate, grade A. 400 million square feet is owned by institutional players. So that's an interesting point which you mentioned. And the other was Mumbai is the only outlier where 90% of India's real estate is tech focused and 10% is the CBD, which I think brings me to the question is, as a result of that, Bangalore players are entering Mumbai in a big way. While that's happening from their maybe business strategy change or to neutralize the portfolio what they hold, what can this room do different to actually gear up to, first of all, if they are heavily residential focused, what's the story on commercial they can think of, and how can they create a differentiation and a place for themselves where large real estate in office side is owned by institutions, and then you're getting competition not only local but regional competition too.
See, fundamentals don't change, right? If you're saying 90% of my demand is going to come from a tech company, where is the tech footprint going? What does the tech footprint want? And where is the tech footprint looking for talent, right? If these three boxes are ticked, you can create an asset in that micro market. There's no rocket science, of course. Having said that, otherwise neighborhood commercial real estate will work, but then you have to be focused on the investor grade commercial real estate, not the tech based commercial real estate. There's a difference. In every micro market, take for example, if you're looking at a range of between 75 to 125 rupees, you will get demand in Bombay. Beyond of that, the tech guy will not take volumes. So if you're doing 10 million in Bangalore, it's in the range of 60 to 80 rupees. If you're doing 12 million in Hyderabad, it's from 50 to 65, 70 bucks in terms of rental. If Bombay tech, maximum tent is at 55 rupees, cheapest in the country. But if you go to Malad, for example, it's 120 bucks in rental. That's where they stop. But certain financial services, it's not really rent. Rent is 2, 3, 4% of your operating cost. It's the human capital you're searching for. Average salary in the Malad and Deri belt for talent is 40, 50, 60, 70,000 rupees. You move to the Airoli belt, it's 20,000 rupees. So you're going for talent at a cheaper cost. And that's why you're moving to, rent really doesn't matter. If the talent is there, the guy will pay you even 100 bucks. But you need to be sure where the talent is. Based on that, you got to build your asset. So it's not like on one street, I have space, I'll build some resi and I'll build commercial and it'll do everyone's building, I'll build a nice looking building. If you're lucky, great. If you're not, if it's not in the trajectory of that volume of demand, in especially Bombay, it won't work. And commercial is a double-edged sword. Resi, you can give a 500 rupee discount if the view is bad, apartment is a little off, big jagger. Commercial with top tenants will not get leased. You can sell it. Then you create strata title, that's fine. You'll get premium to your rental. You may sell at 12,000, you'll rent at 50 bucks. So you'll say, why should I rent? I'll just sell it off. So those things will happen because the investment mindset continues to be there. And you may be able to acquire that. But the proof is, are you using it or are you going to lease it? If you want to lease it, then the asset has to fit the occupier. So it's not that straightforward and simple. So you've got to be clear about who your customer is going to be. Build the asset for that customer, you're fine. If you don't identify the customer, build spec, it's a double-edged sword.
Interesting. If I rewind back a decade, and I'll coming to Shiv, if I rewind back a decade, the volume versus institution versus say strata owned was 30%, 70%, and now it's almost 60% institution owned, 40% strata owned.
Right.
And earlier, the only investment was hard real estate. Any investor could buy. Obviously, residential remains the flavor. But office also, people are willing to park for good returns on a small case basis. And then come 2015, we see a new innovative model called fractional ownership. And Shiv, one of the established fractional ownership, he runs in the group called hBits. So I want to understand from you, what gap is fractional ownership actually filling in the marketplace? And I mean, how you're able to differentiate, create a two-part, one, what gap you're filling, and then fast forward to today, where we have 3 REITs successfully.
Right.
And then how is fractional ownership versus REITs coming into?
Yeah. I'll get to both those questions. And so in terms of what gap we're filling 2 gaps, right? One on the real estate or developer side, and other on the investor side. So I'll talk about the developer side first. So on the developer side, like you said, about 60% is institutionalized and 40% is not institutionalized. So that 40%, so when you say institutionalized, you probably mean just generally institutions, but if you look at even the market cap of all 3 REITs combined, it's probably, I think, 70,000 crore.
Yeah.
Maybe, considering the future REITs, maybe 2 lakh crore would be REITed. That still leaves about 6 to 7 lakh crore is the total grade A office space. So that still leaves about 5 lakh crore is looking for an exit, right? The developer has built the building, he's leased it out, and now there's an exit required by the developer. Initially, the developer might have gone for an LRD, or they might have sold it to maybe an ultra HNI or a smaller institution like an ICICI insurance fund. But ultimately, you need an exit where the public markets directly get access to this asset class. So from a developer perspective, you still have this large section of developers that don't really have a legitimate exit option, because to really get into the REIT, you need, from a regulatory perspective, minimum of 500 crore, but practical perspective, probably several thousands of crores of AUM to actually get into a REIT model. And maybe you'd have a better idea of this, but if you're trying to sell into a REIT, the margin really is taken by the REIT sponsor as opposed to the owner of the asset itself. So for a developer who has a grade A commercial asset, say several hundred crores, maybe 500 crore, maybe 1,000 crore, traditionally he had two options. One was to exit to, like I said, an ICICI insurance fund where the market is really, really limited, or second to an ultra HNI investor who'd have the ability to buy maybe a floor or a unit in the building, which would cost, say, 30, 50, 100 crore. But again, the universe of ultra HNI investors, especially who understand real estate, because even owning a rented out commercial real estate asset is not an easy task. Just doing your due diligence in terms of CAM, property tax, it's not everyone's bread and butter. So even that universe is about 100 ultra HNI investors around the country. So where we come in is we provide that exit option to developers, where we're able to analyze a property very quickly, whether we want to take that or not take that. And then we're able to fund the property in about 60 to 90 days and give the developer an exit for that asset. On the flip side, coming to the investors, right? Now, investors have only two options in today's market. I'm talking about retail investors have only two different options to own commercial real estate. And this is rent-generating commercial real estate, where yields are obviously 8 to 9%, and with appreciation, you can make a 13+% IRR. So one option is obviously the REIT, where your entry point is significantly lower. And then there's fractional ownership, where the minimum ticket size of 25 lakh, you can own part of a commercial asset. And the convenience, I'll come to the comparison between fractional ownership and REIT in a second. But in terms of fractional ownership, obviously the ease of investment is very, very simple in terms of, you get the full video walkthrough, the photos of the property. You can pick and choose which property you want to invest in. You can do your full due diligence in terms of financial model, information memorandum, even to the level of you can see, because some investors want to see this, you can see the leave and license agreement with the tenant, you can see the title report, it's all on our dashboard. The full transaction also is completely online compared to a traditional process of owning. So some of our customers, they traditionally would have owned a residential property, a second apartment as an investment. There's still a lot of hassle, groundwork, paperwork involved. Here, the full transaction is completely online in terms of payments and documentation. In fact, 30% of our investors are NRIs, so they haven't even come to the country to invest. And then you can track your real estate portfolio on your dashboard in the same way you can track your online stock portfolio on Zerodha. And then you can exit your share on the platform. So that's why from the investor's perspective, who wants to invest 25 lakh, traditionally might have owned a second apartment, might have put that money in FD, this is a much more lucrative option. Because residential, obviously, yields are 2 to 3%, FDs are maybe 5 to 6%. Coming to the difference between REIT, obviously, underlying asset is completely the same. It's commercial real estate, rent-generating commercial real estate. There are pros and cons to both. I wouldn't say that one is better than the other. It just depends on the investor psychology. REIT, obviously, there's a correlation with the stock market, which we've seen at least in the foreign markets. When stock markets move up, REITs move up. When stock markets move down, REITs move down. Here, there's a little bit more diversification away from the stock market. Second, what we've seen in terms of psychological comfort is obviously REITs like a mutual fund where you're investing in a basket of assets that have several different tenants. Here, you get the ability to pick and choose which asset you want to invest in. And some investors want that diversification. They don't want that headache. Some investors want to pick and choose where they want to invest, because one is obviously they want to do their level of research and analysis. Another is just the psychological comfort of living in Mumbai and saying, if you live in, say, Andheri West and you own a property, part of a property in Andheri East, you're a little bit more comfortable, you're a little bit more familiar, you feel you've done your due diligence. And even the level of analysis that our customers do, that psychological comfort they get in investing through fractional ownership.
And if it's okay with you, if you can elaborate how the process runs from, say, identifying an asset, raising the funds, managing it, and the whole life cycle till the exit.
Sure.
And what are the touch points, warm and cold, from an investor perspective during the life cycle?
Mm-hmm. So you're asking from an investor perspective or from a developer?
Investor perspective.
So from an investor perspective, first we list the asset on our platform, on our website. And we have multiple investors, visiting our website. We have like a strong digital marketing team, as well as we work with channel partners and brokers who also lead investors to the website. There, like I said, they can see all the details of the property. And once they decide to invest, that transaction in terms of signatures as well as payments is completely online. That's the digital age that we live in today. So we've inbuilt that onto our platform. Post that, what the document you're signing and what you actually get from an investor's perspective is that each and every asset is placed in a separate private limited company, and investors get shares and CCDs in that private limited company as per the amount that they are investing. So then they own the asset, they track their monthly rental on the dashboard where they can view that, and simultaneously on a month-by-month basis, as the tenant pays the rent into the private limited company, it's dispersed into the investor's bank account as interest in CCD, getting a little bit technical over here. So as interest in CCD, it's dispersed into the investor's bank account. So that happens on a month-by-month basis. Investors then, and we've just gone through one of that recently, investors that can then exit their share on the platform. So investor wants to exit for whatever reason, he or she will list that share on the platform at a price that he thinks fit. We provide guidance as to what the price should be using third-party valuation reports. But investor can pick and choose. If he bought it at 25 lakh, he wants to try and sell at 28 lakh, he can list it at that price. And we already have 30,000 registered users on the platform. And a new buyer can come look at that as an opportunity and decide to buy in, and then the transaction also happens online. Otherwise, in 4 to 6 years, we look to exit the full asset. Once obviously the first escalation has probably kicked in, at which point we'll go into the market, get prospective buyers for the full asset, place it up to the investors. Once 75% of the investors agree through a voting mechanism on our platform, then we exit the full asset.
Interesting. So again, similar question to what I asked Vinod was, from this room perspective, what do they need to do? Do they need to do something different to also keep an idea or an exit route from a fractional ownership perspective or REIT perspective?
Right. So, I mean, if we're looking from we pick up any rent generating asset that meets a few parameters. So we look at obviously offices, along with that, we look at warehouses, data centers, even schools and hospitals. In terms of parameters that we look at, and this would be kind of across the board in the fractional ownership industry, I think it's pretty much the similar points that would make it a lucrative asset to invest in. So few of the major points would obviously be your tenant profile that's occupying, the strength of your leave-in license agreement, including the lock-in being the most important part. And then obviously micro-market is very important. We look at the supply and demand contours of that micro-market, including obviously ensuring that the rent and capital value that we procure the property at is below, at or below market value. So once those parameters meet, we're able to fund the asset very, very quickly once we place it on our platform.
Interesting. Well, from your perspective, I know you've almost 19, 20 years managing corporate real estate privately versus now a REIT manager. Any differences or any learnings or?
No, I think it's fundamentals don't change, right? To become a REIT, obviously it was a 5-year journey for us, because you have to remember that a REIT investor is a sophisticated investor who understands real estate as an instrument. We don't have too many educated investors in India yet, right? That's why the global investors take away 90% of whatever you offer. To have done a REIT right in the middle of the pandemic, people were telling us you probably lost it, but we got 16 times oversubscribed. So primarily it was really the global investors who saw things the way we thought they would not see it, right? Having said that, when can you do a REIT? You can do a REIT when your debt levels are far more controlled, because you have to distribute 90% of your earnings, and the earnings will drive my value. Because if I don't give you a yield of 6.5 or 7% tax-free, you may not buy my stock or my NAV will drop, right? So that is the starting point. And with 80% completed assets and 20% variable where you can develop, that's what the REIT allows you for. You're not allowed speculated. I can't buy land in a REIT. I can only buy brownfield or completed assets, right? So the legislative framework is so strong for the investor that you can't do it overnight, which is why you saw the largest deals take place of established players in India selling away their assets to the Blackstones and Brookfields of the world. I mean, they could have easily done a REIT, but they were 70, 80, 90% in debt. They had no option. And they were just bought out by Blackstone or Brookfield or whoever else. So debt is the starting point, right? Second is, for us, a customer is like credit risk. So we will never run for the highest rent. We'll always make sure the tenant that occupies this asset is going to stay there. Lock-in is cosmetic. Today the client is spending upwards of 8 to 10,000 rupees a square foot on interiors alone. He's not taking your space for the rent. He's taking your space for the operations and the business that he's going to generate from there. Rent is just 3-4% of his operating cost. So if fundamentally what he's doing is right, then you have a solid tenant. And that tenant will then grow with you. So if you keep to those fundamentals, you will get recognized. Obviously, for the last 18, 24 months, there was so much uncertainty in the market that except for the global investors who didn't disturb their equity, the rest of the investors were just not coming forward because the headlines were offices are gone, people are going to work from home, everything will shut down, we'll convert them to apartments very soon, etc., etc. So now nobody asks us that question. So next 6-12 months will be interesting. You've already seen the stock prices balloon up by 25% in as short period of time as 3 months, right? Nothing changed. Rents haven't changed. But having said that, it's the perception that's changing. But a whole lot of education needs to get done. So you have to think differently as an asset manager, not as a developer when you're running a REIT. And if you're the right, same thing for your business. It's
Correct.
really the differentiator is asset management.
Absolutely.
If you can demonstrate that you're taking care of the asset and the occupier, then you will always be at a premium to market. You look at REITs all over the world. I mean, India has just 3 REITs. You have 865 odd REITs listed globally. 1.6 trillion in US alone, right? 25% of those REITs are in Asia. China, if you see, started REITs in 2021. They already have 8 REITs listed. There'll be 25 REITs in the next couple of years. So it's really about the asset quality, asset management. It's nothing to do with the building anymore. So that's really where the difference is. So you've got to keep sticking to the fundamentals. Nothing changes.
Great, thank you.
I wish I got the multiples of the rest of the IPOs on real estate. We are doing real estate. We get paid on NAV, not on the growth multiple. So you're far safer here than you are anywhere else.
I totally agree. Now let me come to the most talk of the town asset class, the data center asset class. Very interestingly, 2021 saw Mumbai as a city absorb 55% of the entire India's capacity. So just to give a number, 116 megawatts was the absorption for 2021 in India. Mumbai was about 52 megawatts. What's more interesting, next 3 years, we're expecting a 34% CAGR growth, and that cumulatively is $5.5 billion of investments, which will go into only data center in the next 3 years itself. And again, Mumbai continues to be the attractive proposition. So with that, Rachit, I think you're the DC expert for many years, and I'm a layman, I'm assuming. Please educate me what DC is, and in that bargain, I think even people can pick up some ideas. Just start, I mean, what DC is, who are the stakeholders, how is it playing out, just to start with, and then I'll come to more questions.
Thanks. I think I'll actually take 1 or 2 further steps back, and number one, I think rather than just addressing it as data center, I think we, the way we look at it, we actually encompass it holistically under the brand name of digital infrastructure. And what is it that we are building in digital infrastructure is something that we all need to understand. If we just look at how technology is growing, and some of this may seem very trivial, but I think it's important to understand the impact of some of these things. Today, you guys are all using Netflix, we're talking about gaming, we've got zero latency. Everybody's, doing all these kind of augmented reality experiences. All these things have started off. But when you look at infrastructure which is coming in globally, and especially in India, we've got 5G, which is, which is getting rolled out. Once 5G gets rolled out, all of you would have much faster internet on all your devices and much more bandwidth available, and not just in the urban centers, but more rural areas as well. Number two, we have fiber connectivity, which is going deeper and deeper into the country, which means many, many more people are going to have internet, and internet penetration would increase multifold at very, very high speeds. Even in rural areas, or areas like northeast part of the country, Andaman, all these places are getting connected now. And then over and above, now we also, I don't know if you guys followed this announcement of OneWeb, like satellite internet coming into the country, which means further deeper also. Now, with all of this happening, now imagine if, let's say, 1.2 billion people who have, who live in India, out of that, let's say X number of people actually have fast internet with bandwidth. In the next 5 years, that is just going to multiply multifold. And with that happening, and then you think of, along with that penetration, think of the use case, right? In 5 years from now, you're not going to, Netflix with 4K television is going to be completely obsolete. You are probably going to be using something like a Microsoft Mesh or a HoloLens 2 and have a completely different augmented reality experience, which might be 64K or God knows how many K of this thing. Now, all of that, which is getting, which is very, very near future for all of us, is going to require storage of data, connectivity of data, compute, where actual compute is going to happen. Imagine, today, let's say Microsoft has gone and acquired Activision, a big gaming company, right? Now, if let's say someone in Mizoram is playing a game over there, right? And he requires that kind of high-end compute and high bandwidth internet, which would suddenly be available to so many more people. The amount of infrastructure which would be required to support all of this, and that whole thing holistically is digital infrastructure, right? And when we break that down, one of the key parts of digital infrastructure comes right from towers to fiber to subsea cables to data centers, which is like our favorite topic today, right? And that data centers, there are going to be different use cases for these data centers, right? There are data centers, let's say for someone like an AWS and Amazon Web Services, having a large, core data center kind of a location, they would need a large land site, and they would need very, very large scale, low cost data center, which requires, what does it require? It requires cooling, it requires power, it requires space, and it needs connectivity, right? So all these kind of data centers which are going to get built will require all these kind of things, which means water needs to be available, power, and these assets are absolute guzzlers. So let's say, for example, if Amazon or Google are building a data center campus, which is their core campus where all the compute and all of this is happening, these could be in multiples of hundreds of megawatts of power being used. And it's not very far for us, all of this kind of consumption coming in, which means you need to have infrastructure of power available. You need land, and in all of this, land is actually the cheapest part of it. Let's say in Navi Mumbai, land would be what, 25-30 crores an acre. The construction cost of a data center would be, let's say, 5,500-6,000 rupees a square feet. But the fit out and the actual investment in it would be upwards of 30,000 rupees a square feet. And then we are doing this over millions of square feet. Now, that is a big hyperscale core site. But at the same time, there are going to be different kinds of data centers, which would be more connectivity based, which are a lot like, let's say, imagine telephone exchanges used to be around. The same way you would have these connectivity, let's say in every city, in city center locations, you'll have these connectivity-based exchanges, data centers, and similar other concepts will also be there. Especially in tier 2, tier 3 cities, we are going to have these smaller 10, 20, 30,000 square feet type of smaller data centers right in the city center, which are going to be there, which will all offer connectivity solutions for this internet infrastructure. Coming to Karan, your point of who are the players, what are the things, I think there's a land, which is the land play, which is there. On top of that land, of course, there's power infrastructure which is coming in, and the real estate development of the actual building which is getting done. Under the REIT, of course, Vinod recently announced last year where he's developing a data center for an operator, where it's a land building that they are constructing, and they've given it on a 40-year lease, right? And they'll have a rental income coming in from that kind of an asset, and it's a beautiful, beautiful asset to have as part of the REIT. Think of it from these educated investors who are getting very, very high quality, safe returns from this kind of a tenant. The second part over here is the operator, who is going to come on top of this real estate, who's actually doing the investment in the MEP and the fit out of the actual data center and actually operating that, where their job would be to find the Amazons and the Googles and the other enterprise customers who are going to place their servers in these data centers. So there's a real estate play, there's an operator play, and then the last is going to be the customer play, who are actually going to come in and lease this. Hiranandani, which has gone into this Yota platform, is one where, as a real estate developer, they've also decided to be the operator. So both the real estate company and the operator company are their own. Those are, they have a structure around that. But there are many others who are only in the real estate, many others who are only as operators.
Interesting, and thanks for the elaborate explanation. So, two sub questions. Obviously, Mumbai over the next 3 years will continue to have the maximum demand. Reasons why. Number two, this group, what can they do to attract that demand? If not majority, some part of it, and how can they participate in this asset class?
Yeah, I think from a city perspective, Bombay and Chennai are two most important cities in the country because the subsea cables are landing in over here. Now think of the big data centers and big cloud campuses in international locations like Singapore or the US in Ashburn and all these kind of places. Their first port of connectivity landed in these two cities, Bombay and Chennai. Now, Chennai had its own challenges around whatever natural disasters and floods and stuff like that which happened. But while that happened, Bombay, being a very, very stable financial capital and a port city of India, ended up getting a lot of the benefit. So a lot of the cloud players, a lot of the customers decided to bet on Bombay as their main infrastructure. And Bombay is not a special city. You'll see exactly the same thing in Hong Kong, in Sydney, in Tokyo. All these cities are very, very prime data center markets, right? So that is what has happened. So growth is going to happen, right? How we can be a part of it is looking at land holdings, how we can really think innovatively. For larger scale, the appetite is 100% there. Today there's appetite to look at 20, 50, 100-acre land sites where scalability can happen. But at the same time, there are connectivity type data centers where in city centers, in locations like Chandivali, Andheri, if you have land sites, we can look at those kind of things. From a development perspective, if let's say there are correct land sites which are available, which are developable, there are operators who we can tie up with and actually build a strong platform in any of these kind of locations. I would also urge the whole tier 2, tier 3 city story. In the times to come, tier 2, tier 3 cities like Lucknow, Coimbatore, Jaipur, Ahmedabad, Calcutta, all these kind of cities are going to see a lot of growth of, these kind of data centers will come up. And there will also be opportunity, especially when you are looking at any land, especially in city centers, close to the telco infrastructure. It's going to be a very, very interesting land, and we would be happy to evaluate if there's something that can be done around that.
Great, thanks.
Thanks.
Coming to you, obviously in-house view on DC, and if I have to tell you to take a jab, say fast forward 8 years from now, how would you see DC component in terms of overall commercial portfolio contribution?
I'll just probably continue from where Rachit left off, because there are a few points that they would like to hear, which probably I thought I'll cover in addition to what Rachit has said. Primarily what's happening with data centers is, like he said, the starting point to them is power, the optic fiber infrastructure, and obviously the safety and security around putting that site. Now what is important is they don't do more than 2.5 times land density. So if you're looking at FSI exploitation, it's not going to happen. If you have a 1 acre land parcel, it may not work for a data center. You require minimum 2 acres to put a data center block, which will be between 25 and 35,000 square foot floor plate, right? When you do that, they will stack up to 6 or 7 floors. Now, if you're in a high density residential neighborhood, you're going to have 150 decibels of sound in the night. And with India, with democracy, if someone puts a dharna, your data center shut down. You're screwed, right? So you have to be extremely careful about where you're putting this and how it's getting built. And on the flip side, if you have power, access to a substation close by, the guy will pay you an arm and a leg to take that asset in a Chandevali or Andheri or wherever you have catchment, because to him, primarily you should remember what's going on is India has brought in a new rule for data management, which has to be captive on ground domestic. Otherwise, an Amazon or a Google or Microsoft could keep data anywhere in Timbuktu, for example, and overnight data could be ported out. Now they've been forced to put domestic data on ground, which is why they have now come to India to set up their data center. They don't love India. They were like, we used to call them UFOs 5 years ago, because they would come in weird shorts, and all kinds of weird people I have met who look at data center technology, and they come and see and then they fly away. In the last 5 years, now they've started to come and explore land. Now what has happened, what happened to logistics has happened to data centers. Suddenly the funds realize that this is a massive opportunity. They have cheap capital. So a 6 crore an acre land is now being bought at 20 crores. And they are parking on that land and sitting on it, right? That we will build the data center, then we will REIT that data center, and we'll exit in 5, 7, 10 years. So that's why the market has gone crazy. So it's burning hot. You will burn your hands if you enter right now. If you have land parcels and you think you're in the right spot where you can access power, and you're fine with the return expectation of lesser density FSI, because we get stuck in density and then the mat doesn't stack up, right? In this neighborhood, there are 5 data center buildings. Bank of Baroda is a data center. Tata Telecommunications is a data center. These guys built it in BKC when there was nothing. They will all move eventually. But having said that, if you can give them something in BKC, they'll pay you 300 rupees rent, 400 rupee rent, 500 rupee rent. They don't care. They want a data center for certain clients. All the banks have 5,000 square feet in their office as a data center. They'll all port it here if you give it to them. So it really depends on where you are and what your return on equity is that you're expecting, right? Take it to flip side, why New Bombay is working is because land was cheaper. Cumulatively, if I was leasing at 55 bucks, I'm leasing to a data center at 75 bucks. My cost of construction is about 1,500 bucks more because it's 6-meter height structures, loading of 1,500 kgs. So it's an industrial building where they are going to spend far greater than I'm going to spend on the servers and racks and the DGs and the chillers, etc. So I know once he puts his money in, he's not going away anywhere. So it's absolutely safe. And I'm getting the premium because I was in the right place at the right time. And I could deliver in 12 months a 5 lakh square foot building, which nobody will deliver. So that's the opportunity cost. So if you can deliver fast, you can put capex on putting a building, you'll get 10 data center guys, he'll sign with you if you have a piece of land. he's got them all in his back pocket. But that's not available right now, which is why it's going up the way it is going up. So, I mean, we are putting 5 data centers in New Bombay, and we're probably doing 5 more all over India. So the demand is stupid right now. So it's burning hot. You got to be really careful. If you have that parcel, go for it. If you don't have it, don't go and buy land to offer to data center. It will get ho jayega. वो मत करना. But that's broadly the game. But data has to be here. These guys will build cumulatively. So just to give you a broad math, on a 2-acre or 3-acre property, they'll do 3.5 lakh square feet, which is 2 density. For 3.5 lakh square feet, they need 40 megawatts of power. For 40 megawatts of power, they will ask you 80 megawatts worth of DGs, because they do N plus N, 200% capacity utilization. That much more land is needed to stack DGs, and same is their chiller capacities. So on an average for IT, if you're using 0.8 kVA per 100 square feet, they are using 10 kVA per 100 square feet. That's the power. So if you have power, he'll pay you an arm and a leg. It's not about land price. It's about power. You have power, the guy will pay you $500 rent if you have it here. So land doesn't matter. Power matters.
It's driving up the rents right now.
I'm telling you, that's how it is.
Yeah.
It's exactly like that. Absolutely. Correct. You can ask, they'll give you what you want.
No, super insights, Vinod, super insights. I think I'm sure everybody enjoyed that aspect.
Very
Last 5 years I was
realistic.
saying why we don't have BKC data centers to make more money. Anyway, now coming to the other asset class for the evening is logistics, which we don't touch upon. Rewind back to 2006 when we had Everstone and Real Term coming into the country. It was pretty lukewarm from 2006 to 2016. In this sector saw about $200 million of equity investment overall in a decade. And then come the Modi government and the GST, one tax, one nation concept. And with that boom, last 5 years, $2.3 billion of investments in logistics only in India. 200 in a decade, and last 5 years, $2.3 billion. So Adishesh, I would like to come to you. Capital is going berserk on this sector. Product is missing. What can this room do to actually capitalize and be a catalyst for that amount of investment? Even a portion of it would really help. So some insights on that.
So Karan, I'll just come back to a fact. You just mentioned that $2.3 billion has been invested. I think what we missed out is that almost $6 to $7 billion has been allocated towards logistics, right? And this frenzy naturally has happened also because of the way the behavior is changing of the millennials going on e-commerce buying. And of course, the last 2 years, right, really showed us that this is the most resilient asset class. Last year, investors put in more money in logistics and warehousing than office. I think that was the first year that they tipped, right? So there is huge amount of capital which is chasing, and 7 billion is what we now know. There is more capital waiting, right? The challenge, and that's where we are sort of this, is that warehousing is more of a game of multi-city, right? You can't be standing alone in one city as such and saying, I'm going to build warehouse and I'm going to continue to build it, right? If you really want to get the value out of it, you got to be present in multi-city, because that's how the entire ecosystem works, right? You need to have large parks, compliant grade parks, right? And just to give you an example, 100 acres will deliver about 2 million square feet of warehousing. I think that's about 10 acres in Mumbai city, right? So acquisition of land at the right pricing has been the biggest challenge. Secondly, after a point of time, it's very difficult to drive rents, right? Construction cost has been increasing, right? Margins are thin. So with all these challenges, right, how do you sort of make a business plan which continues to give you your efforts worth, right? To your question, how one can sort of be a catalyst to this, I think one needs to evaluate one's skill sets. And here, at least, I feel the biggest skill set is acquiring land at the right price, in the right location, right? And bringing and churning it out at the fastest, right? I don't think one has been able to do that very successfully in most developers, and if anybody has that skill set, I think it's worth an asset class to look into, right? Even from an absorption point of view, we were generally, as per our research, we've touched what office has reached, right? I think what point needs to be taken into consideration is that we track about top 7, 8 cities for office.
Right, top 8.
And let's say that's about 85% of all absorption, right? So about 15%, assuming that 15% is also happening on tier 2 cities which we're not tracking. That ratio here is almost about 70-30, right?
70% tier 2.
Yes, and it's increasing because naturally the connectivity needs to increase. New cities are coming up, new highways are coming up, so the last mile connectivity needs to build. People are now going one step ahead, and people are being spoiled for choices, and that's where the concept of in-city warehousing is coming, right? To the point that people are saying, okay, let's figure out if we can block land parcels within the city, because that's something which will go away, right? It'll get developed, right? Okay, if I'm not here in a particular location, I'll go half a kilometer later. But the way that 10-minute delivery is sort of really changing the world, right? In-city warehousing is going to add value, right? So, short points, lot of capital available, lot of capital who's sort of willing to come into it. I don't think one has been totally able to break the business model to say, who do I really invest with, who has the right sets of capabilities to give me a portfolio worth, let's say, a REIT, right? And mind you, the same amount of capital or the value that needs to get created, and for that value, the millions of square feet that need to be delivered, right? I don't think anybody has that scale other than maybe an Indospace and now with ESR as such.
Interesting. I'll just deep dive more because you touched upon how the provenance of tier 2 is for a logistics sector. Some thoughts or comments on how the large funds are looking at this sector vis-a-vis typical commercial core asset in terms of deployment. Typically, we've seen the large top 2, top 3 funds either going own on core assets for commercial or looking at one partner, one region kind of thing.
Yeah.
Some, you can share some light.
Karan, in my experience, and Vinod can add to it, mostly investors are, the investors that are coming into either commercial or warehousing or who would be coming into DC from a real estate perspective, these are all income chase investors, right? They need to deploy money, and depending on the resilience and the stability of the asset, they decide how much money should I invest, right? Though large deals happened in commercial during the pandemic, I think there was always this question in some of the investors' mind whether how office is going to change, right? How much percentage of work from home will continue this? So though two investors who had a vision of sort of acquiring more because they had belief in the office story, there were many more who put a pause on their strategy till they figured out what's happening. Some of the Japanese investors are still figuring that out to say how globally is the commercial market changing, the behavioral change, right? I don't think anybody had any doubt on warehousing. And on tier 2 cities that you were saying, as I was mentioning, finally it's an ecosystem that I need to create, right? It doesn't have to be naturally, who are we servicing? We are serving the consumers, right? So there is either e-commerce that is driving the game, or there is industrial hubs which are driving the entire stuff, and this is spread out, right? E-commerce warehousing or e-commerce which is driving warehousing is maybe in the top 7, 8 cities, but there are so many more cities who are sort of filling in the entire transport system, right? And with more road infrastructure coming in, right? These hub and spoke models coming back saying that, do I need to have space everywhere, or can I have certain spaces in strategic locations, and then from where I can market to others as such. So we are actually seeing the emergence of local developers, right, who are building great stuff and who are also getting the same importance from e-commerce players because these locations are prime and those cities are there. Rents sort of balance them out depending on how the land rates are and how really, how the entire economics is working. But from a demand perspective, I think it's just booming in multi-cities.
From a cap rate perspective, commercial warehousing similar or?
So
Stress
that's
on-
the funny part. Maybe today, worldwide, naturally, office in a developed market, right? Office should always command higher rates, or rather lower cap rates, right? City-centric, more, or rather more city-specific use for this. However, because we are currently in an imbalance where office is there and logistics portfolios are still coming up and there is this huge rush of capital, currently we're seeing the cap rates that logistic assets are demanding, right, is lower than commercial. My view, naturally, once the stability comes and there is demand and there is supply matching, and there are enough players, these will sort of come close to each other. But at this point of time, there is just a huge rush of trying to build the portfolio. See, unlike what office went from 2007 to now, where people started building their portfolios, right? Even today, there isn't a portfolio, very few portfolios, and which are not on the block. So as an example, for example, Blackstone, right, has always stayed away from construction risk or a land risk in commercial. They've always preferred to buy assets pre-leased as such. But I think they deliberated internally, and it's there for everybody to see. There is no portfolio that you can buy. So if I want to deploy $500 million or $1 billion, can I buy somebody's portfolio? The chances are few, because the guys who have the portfolio are also money managers, right? So I have to do sort of ground up development, and they're tying with developers which traditionally a blue-blooded, American private equity may not have gone to, but you can't be choosers in this part of.
Interesting. Your in-house view as KRC on this sector and any plans of entering?
So I remember 2006 we went and signed the JV with Prologis in Miami. I went there, signed that. We were 50% partners with them in India, and then they went bankrupt in 2008. And today they are the largest logistics player in the world, right? So we studied that business for last 2-3 years. We felt that the rent at that point in time would go down, right? So we got that punt right. The 25 rupee rents moved to 18 rupee rents and 15 rupee rents. What we didn't get right is the yield compression. Okay, so the yield compression is at 6.5%, which is stupid in my view. But having said that, at 18 rupee rent, 6.5 is right. Now, if you want to, as a developer in the community, you see 18.5 rupees. The construction of a Amazon equivalent warehouse is 2100 rupees a square foot to build as per Amazon spec. Okay, assume land cost as sunk cost, you won't get your return. If you're borrowing at 10%, it's 0-0. So you have to go borrow at 6.5%, rent at 18.5 rupees. Assume land was free. So if you go to buy land today at 2 crores an acre or 1 crore an acre, and you're doing half density, it's 500 rupees a square foot to 1000 rupees a square foot, depending on where you're buying land. And then construction cost of 1800 to 2000, and you're borrowing at 10%. Then you're leasing to an Amazon equivalent at between 16.5 to 20 rupees for the 2 crore land. You have a 10 crore land, he'll pay you 35 rupees. So Bhiwandi is not the market you should look at. Certainly across of India, roads are getting built. So obviously logistics is going to come. You can go and punt buy land there and then buy it at 10, 20, 50 lakhs an acre, sanitize title, convert agricultural, get the power infra there will be a nightmare, then put security in and then ring fence it, then start to offer it to a customer. So in this audience, I think land banking is great. If you can get the right locations and you get land cheap, bank it. Building it is like depreciating your land. Selling it as land, let the fund buy it because they are on fire again. So sell it off, sanitize the damn land and sell it off. It's not our job to, I'm doing a lot of logistics for Amazon. We have land which is zero cost. At 18.5 rupees, we are renting to Amazon. Because the land is just lying, I can't do anything else with it. So I'm building warehousing. 10 साल बाद value मिलेगा, 20 साल बाद value मिलेगा. If you go to China, all the warehouses today are now city center. So that's the opportunity with infra. 20 years down the road, your land, you can dismantle that structure and then build commercial, resi, whatever, because the cities would have grown around that. So go for the infra play, don't go for logistics. Punt on the land, 20 years, sleep on it. Build a shed so that nobody else takes away your land. Remove construction cost, marginal cost, land cost, sunk cost, sit on it. You'll make money. In India, we always say that either your children or your grandchildren will tell you you are a visionary because we are growing. Now, whether you want to be called that when you're in a statue or you're alive, that's your decision. But you're a visionary because we are growing. So that's going to happen. You'll get it right, ultimately.
And just add one more point to what Vinod was saying. Currently, there are two sorts of models which are being followed. Either you do the fast churn model, where you get somebody, you have a great parcel of land, you get let's say an Amazon if you're lucky, right? You build it, flip it, some investor is going to give us 7 cap, and you exit out of it, right? Or you hold, you build a portfolio and hold it. The strategy in the second one is that, one, the margins are thin and you have to have holding capacity, right? And what has happened now with rents going up and down, and rather construction also going up as such, you have to have a lot of firepower in your pocket to say, okay, I'll tide over this, right? So that's the game, in my view, for big boys, to say, I have this capital, I can tide over a few ups and downs, but my ultimate aim is to create a portfolio, and some pension fund is going to come and give me yield compression and I'll get out of it. But if you're starting it off and you don't want to take that risk, and if you have a land parcel, I think churning makes a lot of sense, unless you're just holding it on.
Great. So one last question before I open up to the floor for Q&A for the panelists. To Shiv, you've been focused on commercial as fractional ownership.
Sure.
Any thoughts on warehousing as a sector?
No, we are actually very bullish on warehousing as well. We are looking at a couple of assets. And what we've seen, again, from, we're talking over here about maybe global investor perspective and institutional perspective, but even at a retail level, there's a lot of interest in warehousing, because again, the perception is that just the e-commerce play, at a very base level, makes people very sticky towards warehouses, or attracted towards warehousing. And along with that, obviously you get much longer term leases than you do in commercial. And even then, the stickiness of the tenant, because once it's more about a business decision, while for an office space tenant, there's a likelihood, depending on how their human capital moves, that they could move. While in warehousing, it becomes much more stickier.
Interesting. Thanks. I'll open up the floor for questions. Feel free.
Everyone on the panel, what is the reaction to the rising construction costs across asset classes, and what is it that people are doing against that?
I'll take a jab because I'm in midst of one transaction, again on the warehousing sector. Large box of million plus square feet in Bhiwandi. We agreed terms in November, and obviously last 3 months has been very crucial in terms of the price increment. And thankfully, the corporate understood, because they've been also following, and we did a price manage. It's great of the corporate also to understand, because it's a large box and designing is still going on. There's no concrete poured. And
they were open to kind of
they
have
open,
a change.
Yeah.
So they realign the sale price to cover the increase in cost.
Exactly.
And this asset was being built and not...
No, design stage.
Wow.
Which is why we could pull that through.
I really want to hear Vinod's answer,
I want to hear Vinod.
because I really want him to decode it like he's decoded every asset class to the T with costing. The poor data center guys must be wondering, what are we sitting and doing out of there? We should come here and take the business plan and finish it. So I really want his answer.
They're taking all the buildings from him, actually.
I'm happy. I'm waiting for them to take the Mihan ones. I'm right behind him in line. So I'm very happy. Please do that.
I'll just remind him, the worldly asset, the rents are way higher. So don't...
It's low, it needs to go up.
Yeah.
Please, I genuinely want him to take the rents and rates up. We'll all benefit from it. I'm very happy he's doing it.
No, I think, see, it's like this. on an average, 3 things have happened. One is, obviously, your densities have gone up. So for residential real estate, that's going to cost you a lot more money. Secondly, because the densities have gone up, time to build becomes longer. And thirdly, your inflationary cost of steel, cement, concrete and all the other elements are impacting between 12 and 18% depending on what you're building, right? Now the panic is cut cost means cut spec, make smaller apartments because costs are going up. On the other side, cost of debt to the investor is going up. So you want to alter your product for current sales. So what's happening, the cycle has gone up, you're shortchanging your product, and you're in a highly inflationary environment where we don't know when it's going to stabilize. Now where you've already started to build, you don't have an option. If you believe in that product, build it, otherwise stop. The way I see it is, I think it's a massive opportunity because I don't think more than 30% of the supply on the drawing board will come. So if you believe in your supply, pour concrete. You will get the premium for your asset if you build it right. You got to be 100% correct about what you're doing. Do not cut spec just because cost has gone up. Be smart about your density. Be smart about your development. Sometimes the economic profit of reducing density can be far greater than maximizing density and killing your economic profit. Time value of money at the same density. So you have to find that indifference every time and give up on density for time value of bringing asset on the table for residential real estate. Same thing for commercial real estate. Everything's gone berserk. Pune is now 8 FSI. Hyderabad never had a concept of FSI. Bombay is 5 and 6 FSI. So every time you meet a landowner, he says, I want FSI. Right? At that FSI, you're going to increase time, cost, holding time, and with more supply coming, rents are going to come down. So you got to be sure and you got to say, I'm not building 5, I'm going to build 3.5. You want to give me the land, give me, otherwise I'm not taking it. So you got to know in the next 24, 36 months, can you bring in supply because there's not going to be supply. So you will make your premium if your product can be delivered and your cash flow starts in 36 months. If it's 48 months, 60 months, wait. Don't go for the density, it's going to kill you. So that's really what, I think the inflationary impact is 12, 18 months. It's not going away in a couple of months. So this will keep staying at that level where steel will be between 75 and 85,000. It's not going to come down to 45 and 50,000. And if you're now building high density, you're 11 kgs per square foot. Earlier it used to be 5 kgs a square foot. So it's $500 of steel cost alone. So you got to be very careful. Your cost goes up by $1,000. You're not asking 10 rupees more in rent for a 70 lakh asset. They're not going to pay me. Unless it's a data center guy. Then I don't care. So you have to be very careful where you're bringing in product because supply will come. Some people will make mistakes. The volume will be there. Rent pressures are going to be there. Costs are going to be up. But there is an opportunity because you can pour concrete where you think you will get the value. You have to live with the inflation. You got to be smarter. That's about it.
And what are you doing with under construction?
We're building.
Y'all are not passing
stopping
on anywhere.
No, not cutting spec.
But y'all are increasing pricing?
We will increase price. We won't lease now because supply is not coming.
Yeah.
That's what he was telling me. I said, I'm not reducing rent. You have a tenant, when he's ready, bring him.
Nice.
Nice. Anybody else?
So, from a real estate perspective, I mean, mainly aimed at you, and also a generic question for the panel. That as developers, like Vinodji said that we all have a lot of land, and he said just churn the land, don't bother building anything on it. So, but if we want to get from point A to point B, we may have land which is ideal for a data center, or we may have land which is ideal for a last mile warehousing. If we want to get from point A to point B, how do we get from point A? What is the intermediate funding avenues which are available to us? And because like for example, Shiv will be interested only when my building is made.
Yeah.
Similarly, all these guys would be looking at us only where we've traveled a certain distance. So how do you suggest we get there? Sorry.
So interesting, and I'll look at Adishesh to add to it. My initial feedback would be, I think obviously if you're looking at point A, point B, I'm assuming it's still land clearances to get to where it's more market, where it's ready to attract one of the asset classes, right?
Yeah.
And that travel, obviously, my view is an HNI who believes in real estate factor would look at like a co-ownership kind of structure, or maybe somebody says, okay, I'll give you Y value, which is X plus sub. If X is the value, X plus 20% as premium, but get me to that stage, escrow. But you do the hard work, you do the liquidation, whatever it is.
Yeah.
And that's one angle.
I will, sorry, just
No,
before
please,
that.
please.
No, I will add, we would look at, under construction as long as tenant is in place and approvals are in place.
So a question to you, sorry, since
Yeah.
you are answering that.
Yeah.
You mentioned the exit strategy for the investor.
Correct.
Where they sell the shares.
Correct.
What would be the dividend distribution tax angle on it? Matlab, that would come into play, right?
No, so when you sell the shares or when you distribute the rent?
Distribute the rent as well, and
Yeah.
also, when
So when
you're
you-
liquid, yeah.
So when you distribute the rent, we're distributing because the investor owns a combination of equity and CCDs,
Yeah.
convertible debentures. So the rent is paid out as interest in CCD, which is very tax efficient because the company itself becomes tax free because the interest is an expense. And it's taxed in the investor's hands as per his tax bracket. And when you sell the shares, since they're selling shares and CCDs, if it's longer than 3 years, it becomes long-term capital gains.
All right, perfect.
So, simple answer to your question is that there is capital available for every asset class, right? For residential, if you require capital, there is CFL available, and if there is experience in delivery beyond this, happy to sort of figure out funding around that. If you're talking of any other asset class, which is either a data center or a warehouse or office, right? I think the decision needs to be made whether you want to build speculative, which then stems to how much confidence you have on the location and the asset, or you want to go the pre-leased way, right? If it's pre-leased, part of the risk is gone, and there are enough banks and lending institutions who will fund you. If you're doing speculative, right, I think that's where lenders start evaluating risk, right, and how much equity you have already got and what the location is. So I think one has to look at it from a holistic point of view as to where you want to reach and what risks you want to take, and accordingly one will figure out the funding.
Karan, what happens in Bombay, land prices देख के हम लोग थक जाते हैं. उसके बाद, to travel the other half of the journey becomes extremely difficult for us. So that is a major challenge in a city like this.
It's like how much profit you were willing to share. With whom?
Of course, of course.
Hi, can you share, you said in city you need warehouses. What is the size and how do they take it up?
So they can lease your space, right? 30 to 50,000 square feet. Every person has a different requirement and they have pin codes for it. And in rare cases, in ideal case, they would want you to build it. But as one of the panelists was saying, because of the way that FSI works here, right, I won't be able to give only a build to suit in-city warehousing, right? So one will have to customize it, or one will have to structure it in a manner that you are able to utilize the FSI and still sort of give the required in-city warehouse to one of the guys who are looking for it.
In some of the
in-city, just to add, in-city, just to add, so if it's, again, pin code based, so I'll tell you that the two big wigs, be it Walmart or Amazon, Walmart being Flipkart, they look at pin code. So if it's a density like, say, Powai or around, they'll have a DC, which will be about 25 to 30,000 carpet, roughly. And if it's, say, a support to the DC within the city for a 10-minute delivery, that will be like a 5,000 square feet. And dark kitchens, which are again another thing which Zomato, Swiggy's, and you'll see more of that continuing, because eventually they're planning to also fund restaurants depending on the data which they're collating, location by location. They'll be funding the operator in their own dark kitchen, so it's backward integration. That also is about 3,000 to 5,000 square feet carpet. Again, like he said, I mean, FSI, you need to get the game right. And just to close my comment is, Japan again, land is pretty expensive, and we've seen Japan deliver in-city warehouse, multi-storied, which is again, hopefully we'll see the first one fast forward in 18 to 24 months by Indospace, because they've just done land acquisition in the city, and they plan to actually do a multi-city. So let's see how that pans out, and maybe Mumbai. Eastern suburbs.
No, that was exactly what I was talking about. And these can be ground plus 4, ground plus 6 type of structures with a ramp around, where you are able to take your truck and trolley right to the top. And that is where, there are elevators and all also, but multi-storied, in-city warehousing, that is something which is being socialized in international markets, and it's need of the hour in cities like ours.
And they're investing money on automation. So I think they're believing, because they're giving automated kind of solutions, all these players will pay the top dollar rental. Let's see how it pans out.
I want to make a comment to the previous point on rising construction costs. I think along with the rising construction costs, another thing that we all need to be extremely cautious and conscious of is the supply chain challenges which are happening right now. And all the long lead items that are getting delayed across. I want to particularly bring focus to, let's say, the data center industry, what's happening, because there's heavy reliance on the capital goods like generators, air conditioning, chillers, bus bars. There are 9 months, 12 months delays in all these kind of products. I can only imagine that same thing is happening with glazing, with all kinds of other imported materials across, and that's something that one should definitely keep in mind, because that can impact your entire project.
Any more questions?
I have a question. So, is there any particular reason why Bombay sort of stayed behind Hyderabad, Delhi, Bangalore, in terms of we haven't been able to get built-to-suit properties, sort of build? It's not really been there. All the sort of corporates have gone to other cities, whereas places in the MMR are maybe as cheap or maybe offering a similar price point. Is it solely because sort of the cost of living is high, or you're not able to find sort of talent, or is it something else?
No, 50% of what we build in Bombay is built to suit.
So again, y'all are one of the few guys who've been able to crack it. But as an industry, I mean, none of us.
Everyone's done built to suit. Oberoi did built to suit for Morgan Stanley. Nilon has done built to suit for JP Morgan. Depends on your clients. There is enough and more built to suit that's got built in Bombay.
But I'll just say to that, I mean, it's again, if you look at the decade between 2005 2015, where IT was taking off, obviously Bombay missed out a lot. That is predominantly tech talent. But he stands correct. I mean, he's right. Last 7-8 years, Bombay finally is coming back, and these space guzzlers, especially global banks, right, who actually outsource to Infosys, TCS of the world, believe fintech talent, Mumbai, you can't get better than that. They are insourcing those jobs plus exporting jobs from other home markets of US and London. And two names which he's taken is exactly the same story.
Many of them.
And you see it continuing a lot.
Yeah, absolutely. In fact, more now.
Yeah.
Yes.
Vinodji had pointed out very importantly that there's sort of a mandate for data centers right now that they have to host data from within the country itself. Now, Rachitji, to you, this basically then the idea of data centers and this currently heated environment is tethered on two very important points. One is the fact that if this data has to be hosted here tomorrow, if data goes decentralized, what happens to that requirement? And second thing is the power requirement. It is only going to be a matter of time that this traditional source of power is going to hit the end user, and eventually you're going to have someone say that big corporates can't be using power like this. So what are the ways which they are going to find around it? Because we've seen it happening on mining farms around the world. You see the future essentially for data centers to sustain.
Yeah, Thanks for this question. I think, and just to highlight, this is the data localization laws that we're talking about, and a lot of the data localization is yet to happen. Just to give you an idea, Facebook, which is, and India is probably the biggest market, right? They have Instagram, they have WhatsApp, they've got Facebook, now Meta, and they don't have any data center presence in India. Only small connectivity presence. There is no presence. So what the government is trying to push is that these kind of companies are hosting our data, your photographs, all of those need to be over here. And they're using various levers, like for example, banks, right? A lot of our banking data, they are forcing all the banks like Standard Chartered, Citibank, Deutsche Bank, all these kind of banks to host our transaction data in the country instead of internationally. Same thing we saw with the credit cards also happening. So that is definitely going to drive up demand over a period of time as the regulatory framework really gets firmed up. Power availability is, in India as of now, we don't have that much of a problem, but it's definitely an issue in markets, in US markets like in Virginia, and even in some of the European markets in France and Germany. Our colleagues are complaining about land is available, but power is not available. In fact, there are places where land has been purchased and power is not available for 5 years because they're waiting for the power infrastructure behind to get augmented. And please appreciate that there are competing industries, right? In the US, in Virginia, we've got EV manufacturing, which is like another new kid on the block which is coming in, and they want to put up all these big American gigafactories and stuff like that, and they are competing for that same power. So there are challenges around that. Another thing which is happening is from the regulatory framework perspective, and India is not thinking on these lines as of today, but there is a possibility in the future that there are thoughts. Some of the extremely developed markets like Singapore and Netherlands actually put up moratoriums. What Singapore said was, after Facebook and Google put up big data centers in Singapore, they said these data centers are not creating direct jobs in Singapore. They said no more big data centers. So they stopped all power permissions. What has ended up happening is power cost has gone up maybe double. Power, data center costs itself, the rents in data centers have gone up triple. Whoever had the capacity. We are busy getting some of those customers into India and other markets per se. But now that they are coming out with new power approvals and all, are very specific for small data centers which are only focused towards connectivity, but not those large data centers. Similarly, in Netherlands and Amsterdam as well, they are coming out with very strong sustainability rules of what kind of cooling mechanism which can be used, what is the kind of carbon footprint that you can have if you are building this kind of a data center around. So those kind of discussions will come up in years to come, absolutely.
So essentially, just to add what he said, technology for data centers is, Microsoft is working on it, Facebook is working on it, is to put deep sea underwater data centers, because the highest amount of energy is consumed for cooling. So what they're doing is the servers are getting smarter and smarter. The capacity each server can handle in terms of storage of data is getting smarter and smarter. So for the same rack, now you can actually store 10 times more data than what you did 5 years ago. And that's changing exponentially. And they are becoming smarter in terms of cooling mechanism. So the energy consumption footprint is coming down. So you will see, of course, in terms of power supply, India doesn't have to worry about power supply. We are surplus. And you have the two big daddies of India now in power, right? And then you're looking at renewable energy at that volume. So by default, in 5 years, I wouldn't be surprised if you may have hydrogen energy running these data centers, right? So all of that is coming at a lightning pace. Infrastructure is just coming like crazy. Power is not a problem. Once they put this equipment, to write it off is 25, 30 years. So even if new technology comes, why are we living in an obsolete airplane? In 35 years, has an airplane changed? No, because there's monopolistic and technology they've not brought in. The same damn aircraft takes 8 hours to fly. We've reached from where to where? but the same aircraft we are flying in, because the average depreciation is 30, 40 years. So data centers for the next 30 years won't change. Technology will keep coming in. Power consumption will keep going down. They'll get smarter. And your equipment life is not 35 years. The building may be 70 years. Equipment will change every 15 years. So they will go on upgrading the equipment every 15 years. And that energy footprint will keep coming. These are massive heat maps with data centers.
Great. So I'd like to close now because there's chilled beer and wine waiting outside. So we can have conversation outside with some snacks. So Shraddha, over to you.
Thank you for an enlightening session, opening a lot more avenues for us, and hopefully more questions, more colorful questions after consuming some beers and wine. Firstly, I'd like to request Deepak Bhai to please felicitate our guests and present them with a small memento and our Youth Wing manifesto.